Welcome back to the Market Insights webinar. It's Kevin Prince here from BMO ETFs. Thank you for joining us one more time for our weekly insights where we want to give you some thoughts around the oil market. Now, I'm really pleased about today's show because we're going to talk about tax loss harvesting. Very insightful, got a great lineup for you. Before we do that, let's get into some of the disclaimers and that stuff. What I'm saying here, disclaimers, and if you've been to the show before, what you know is we're not giving specific advice. We're not giving specific recommendations. What we really want to do is just provide you overall insights and education around the market. Now, one more time, same thing. We have our guests here from Investor Line. They're going to join us. Of course, I use their disclaimer too. So with that, let's get into the topic because this is something we certainly had a lot of questions come in. And again, those people out there that send us questions on a weekly basis, thank you. You really do help guide our content. And please, for those out there who are thinking about sending us questions in, please do that. So from an introduction perspective, let me introduce John Waters. He comes from BMO Wealth Management, leads up the tax aspects and consultation around that for BMO Wealth Management. Alfred Lee comes from BMO Asset Management, and he is an investment strategist as well as an ETF portfolio manager. And Jay Lactuella comes from BMO Investor Line. So thanks very much, panel. Appreciate you joining us this week and sharing your insights. Now, Jay, normally we start off with a tool and walk people through something interesting out there. You have something different to share with us this week. You certainly have 3 ways to invest at Investor Line, but you also have a special offer you want to share with the audience too. Let me hand this off to you.
Awesome. Thank you so much, Kevin. I appreciate it. Yeah, let me start by giving everyone a highlight on the 3 different ways we have to invest online. On the left-hand side of the screen, you'll see our award-winning self-correct platform. This is for the type of investor that prefers to do their own research and make their own investment decisions. On the right-hand side is BMO Smartfolio. If you're the type of investor that prefers to have professionals manage your portfolio, this is the right platform for you. We do it through BMO ETFs, and of course, you can have access to your account anywhere, anytime online. What I'm most excited to share with everyone today is talk about our Advice Direct platform that's very unique to BMO and BMO Investor Line. This is for the type of investor that prefers to have unbiased, personalized investment advice backed by sound fundamental research to help guide their investment decisions. And I'll be using a couple of stocks and an ETF later in the presentation to really highlight the power of this platform because it's really phenomenal. But I wanted to also share with everyone a promotion we have in the market. If you go to the next slide, Kevin, for those of you on the webinar here today that open up and fund a new Advice Direct account, you could get up to $2,500 in cash back, a very, very rich promotion. All you have to do is use the digital code or the promotion code digital12. When you open up your new account, this promotion ends on January 5th. I'd encourage you to look for more details in the follow-up email. And of course, go online and do some research into this too. It's a very rich promotion in the market right now. With that, I'll turn it back to you, Kevin.
Thanks, Jay. And I look forward to seeing your examples in a little bit, how the power of the tool can be leveraged. With that, let's get into the core topic for today. Again, it's tax loss harvesting. Now, it's a unique concept out there, maybe a longer thought process around it, but it's certainly something to consider as we move into the year end. Now, maybe I can reach out to John. Walk us through when we talk about what is tax loss harvesting, please.
Yeah, thanks, Kevin. Tax loss harvesting is a common year-end tax planning strategy, and essentially you would look at your investment portfolio year to date and tally up any realized capital gains or losses in all of your taxable non-registered accounts. And to the extent you've got an overall net capital gain, you would consider triggering some capital losses to offset those gains and reduce your current year tax liability. Now, however, we always recommend that the investment mandate should guide your decisions. So ideally, you'd look for some securities with accrued losses that you had otherwise intended to sell in the short term. However, even if security is down, we often like the long-term prognosis on that security. So we may be tempted to sell at a loss now and repurchase immediately so we don't miss out on the upside. However, the tax rules require an economic change. So the rules would prohibit a sale at a loss if you immediately reacquire that same security or within 30 days after the lost sale, and you still hold that security 30 days following that loss sale, the so-called superficial loss rules. Therefore, to avoid this rule, what we would consider doing is reinvesting the proceeds from the sale of that lost security immediately, but in a different security that has a high correlation to the one that was disposed of, to maintain that market exposure and avoid sitting on the sidelines for 30 days, since obviously a lot can happen, particularly in volatile markets. So ETFs are often very effective tools for this tax loss selling strategy, since they can help you maintain a similar market exposure without a single stock risk and or avoiding the superficial loss rule that I just mentioned.
Thanks for that, John. And you covered a bit of this here example there, but let me just simply say, maybe give you a high level, why tax loss harvest? Like, what's in it for doing this at this time of the year?
Well, the main reason, Kevin, is the tax savings, because if you have a capital gain and you would obviously pay tax on that when you file your tax return. So the idea of doing the tax loss harvesting is to get the capital loss to offset that, to reduce your tax bill. But we have to recognize, as I mentioned, the importance of the investment mandate and not letting the tax tail wag the investment dog, as accountants like to say. But an ETF strategy can allow you to re-enter the market immediately after that lost sale to mitigate the impact to your investment mandate.
Yeah, I like that thought, because you have conviction in that, let's see, sector, market, whatever it is. You're just keeping a chip on the table while you're invoking the tax loss harvesting thought process or strategy across the board. You know what? Do me a favor. Can you walk us through an example too? I know you did one up for us, sir. I'll bring it up on the screen here.
Yeah, for sure. So let's say we've got a couple securities here, and let's say I can jump to point number 2 here, that we had earlier this year sold XYZ stock when it was trading at a 20% gain. So let's say we purchased it at $100 and we sold it at $120. We had a capital gain of $20 that was realized. And then sort of getting towards the end of the year, we look at our stock portfolio and say, you know what, stock ABC is down a bit. I could trigger a capital loss on that. So let's say I purchased that at 100, it's now trading at 80. I sell it, get a $20 capital loss. The net capital gain is 0 because I've got a $20 gain offset by this $20 loss, assuming that that's all of the sales within your portfolio from an aggregate basis overall. You've eliminated that capital gain that you would have otherwise paid tax on, and have eliminated any tax on that gain for that matter. So the idea here is that you might still want to get back into the market. We can't go into that exact same security for the reasons I mentioned around the superficial loss rule. So you might look at other securities out there that might mimic that exposure on the the ABC stock that you sold.
Yeah, that makes a lot of sense. And I also like the fact that in the example you flatten it out. It doesn't always work that way, but the general idea is there too, try to mitigate the taxes by utilizing those losses to offset those gains and keeping that, as I say, chip on the table for that exposure you're looking for. You know, of course, there's some other considerations. Maybe you can share some of those key things with us too, John.
Yeah, always more considerations in the tax world, Kev. So the first thing that I would mention here is that you may not have some capital gains in the current year to offset, but you could still do this strategy. So the idea here is that you would create an overall net capital loss from all the sales that you undertook in 2020 and carry back that net capital loss to apply against capital gains that you reported in 2017, 18, or 19 to recover any tax that you previously paid on those capital gains that you reported in those years. But of course, again, we have to be aware of the superficial loss rule that says if you dispose of a security, you cannot repurchase that security or an identical security or an option for that matter to acquire that security within the period that is 30 days before and after that lost sale, if you still maintain that security at the end of the 30 days following the lost sale. I would also mention that CRA is sort of one step ahead of you here and says that you can't repurchase the same security in your registered account. So you sell it in your non-registered account, you generate a capital loss. You can't buy it back in your TFSA in that 30-day period or your RSP or RIF or for that matter, your spouse can't buy it, or a common law partner can't buy it back in their account or registered account, or for that matter, a corporation that you or your spouse or common law partner controls. So they sort of one step ahead of you on some of the ideas that often get bandied about. And the final thing that I would mention here is that we want to, if we're triggering some capital losses, we want those to take effect in the 2020 tax year to offset those gains that we have. So the important thing is we need that trade to settle in 2020. So usually with a 2-day settlement period, that gives us right up until December 29th, so that it will settle by the end of this year.
That's very insightful, and it's good to know the actual last date to implement, because it gives some people time to think through the strategy itself. And of course, I got to say, what is our compliance department always says to us? Make sure you remind everybody to talk to their tax advisor before implementing a tax loss harvesting strategy. So think about that too, beyond the 29th, for the dates you have, we just gave you. With that, let me bring Alfred into the conversation, because Alfred, let's talk about why ETFs are, effective as a tax loss harvesting tool.
Yeah, for sure. So John already alluded to, ETFs being a great investment vehicle for tax loss harvesting. But, the reason why is because, when you look at the ETF market, I think a lot of people, they think about ETFs as being these investment vehicles that provide exposure to, very broad markets like the S&P 500, the TSX, which is absolutely true. But the ETF industry has evolved, a lot in the last decade, where you could get specific exposures as well. So if you want to get exposure to, let's say, the REIT sector or the energy sector, or if you even want to get exposure to the pref market or gold bullion, you could do that through an ETF. So in my opinion, I think, an ETF essentially is an access vehicle that allows investors to target virtually every corner of the market. In addition to that, ETFs are very low cost. You could get exposure to, the S&P 500 for, 5 to 6 basis points. When you compare that to, traditional funds, it's definitely a lot more cost efficient. And, ETFs are diversified investment vehicles where it's essentially a basket of securities. So you do minimize that company specific risk. And transparency is also key. I think, as we all know, after the 2008 crisis, it's very important to know exactly what you own in your portfolio. And with an ETF on the ETF provider site, they will list every single holding within that ETF down to the very last holding on a daily basis. So you know exactly what you're getting. So from a tax harvesting point of view, you know exactly what that basket holds, and you know exactly, what kind of exposure you're exactly targeting. So it's very important, I think, in terms of transparency. And last but not least, there's no intraday holding period. So you can buy and sell an ETF on the same day, which I think from a tax loss harvesting perspective, having that liquidity is very important.
Alfred, thank you, because you do a ton of strategy around this area too, and certainly been sharing it with a number of key stakeholders out there. Maybe do me a favor and walk us through maybe a Canadian, some examples, and as well as some US examples of, where somebody can look at implementing a strategy, and walk them through the details of that. And this is a little bit dated, sure. September 30th data, but still key concept there.
Yeah, sure. So, John did a very good job walking through, the example using the ABC and XYZ stock as an example. But why don't we apply these to some of the losses that we saw both in the Canadian and the US market this year? So take, for example, Air Canada, as we all know, got hit pretty bad in the wake of the coronavirus. So that security was down 67% year to date. So one thing to keep in mind is that we are using year to date as an example here. For tax loss selling, you're supposed to compare your book value to the current traded price. But because we don't know where you bought your security, what we did was we used the year to date gain loss as just a reference point. So Air Canada, as I mentioned, is down 70%. If you wanted to sell that security, you can reinvest in the BMO Equal Weight Industrials ETF, ZIN, or the iShares S&P Global Industrials ETF, both of which have exposure to the airlines. So it gets you a good proxy to airline stocks such as Air Canada. Energy stocks, as we all know, have taken it on the chin as well. Synovus and Suncor, both down in the tune of about 60%. So if you want to sell those securities, what you could do is you could reinvest it into the BMO Equal Weight Oil and Gas Index ETF, and also the iShares S&P TSX Capped Energy ETF as well, which is XEG. A couple ones that weren't listed on this table are the banks. Banks have come back a little bit in the last 2 weeks, but a good example is, for example, Bank of Nova Scotia. That is down 15% year to date. So that would be a good candidate for tax loss selling as well. If you want to reinvest it into ZEB or RBNK, which is the BMO and RBC respectively, bank ETFs, those are a good way to get exposure to those particular sectors. On the U.S. side, a lot of potential tax loss candidates as well. Even though we have seen the S&P 500 bounce back, it hasn't been a uniform recovery. Certain sectors have been hit, still have lagged the market overall. So good examples would be the banking sector. The banking sector has clearly lagged the market in the recovery over the last 5 to 6 months. So good examples would be Wells Fargo, Citibank, Bank of America, all of which are down notably this year. So if you want to sell those and reinvest it in the BMO Equal Weight US Bank ETF or the RBC US Bank ETF, ZBK and RUBH respectively, those would be good strategies in terms of staying exposed to the sector so you don't miss out on any opportunity costs.
Thanks, Alfred. I think you're right. I mean, what you're really trying to say is, here's some alternatives to hold, and again, keep that chip on the table, but effectively come back to it in the future if you like that position. Now, I'm going to bring Jay into this because, Alfred, you've got a lot of experience. You know that you've got conviction to stay in that security, the whole works. There are people out there who may not have the same kind of ability to provide conviction to say, do I want to come back to that security? Jay, talk to us a little bit about how Advice Direct might be a supporting tool for somebody in their decision-making process.
Absolutely, Kevin. Thank you. Let's go to the example. And I have to say, folks, before I dive into this example, this is only for illustration and educational purposes, right? In no way am I giving you any advice over here. I use the bank. I don't know if you caught this on Alfred's previous slide. This is Trust Financial Corp, ticker symbol TFC. It was down about 30% as of September. Of course, we know since then, after the U.S. elections and after the 2 successful vaccine trials, the markets have moved up. But again, for the sake of tax loss harvesting, if we go with it being down 30%, you now need that conviction. You need that validation. After 31 days, should I be going back into this particular stock? Well, enter Advice Direct. At a few clicks of a mouse, really, you type in the ticker symbol, hit research, you can pull up this report. And I know it's a busy slide, so let me help break it down for you. On the top right-hand side, you will see a buy recommendation with a 62.3. Really, that's a scale of 0 to 100. Anything over 60, we recommend you buy that stock. Trust Financial gets a grade of 62.3. How do we come up with that grade? If you look at the first half of the slide with that circle, it's divided into 4 quadrants. And really what we're doing here is looking at the fundamental data of this company. If you look in the first half of the quadrant, the valuation side of things, the more blue you see there, folks, the better the company is doing in those metrics. Those metrics are things like dividend yield, price to earnings ratios, etc. It gets a grade of A. So we're saying from a valuation perspective, there's still value in the stock. If you go below that and you look at cash flow, it gets an A minus. Decent cash flow for this regional bank out of North Carolina. And then there's other metrics like growth and profitability as well. So if you're an individual investor and you don't have the experience or expertise like Alfred, you are taking a loss on this and you want to go back into it, you would pull up a report like this and you would have that conviction to say, okay, I'm still going to be able to buy this stock and the fundamental data supports that. On the second half of the slide, you get a breakdown of the sector and the industry, but what I want to draw your attention to is a sentiment score. It's that box at the bottom half of the screen that has those letter grades in it. So while we're giving you the fundamental data, we're also providing you with some sentiment and some technical data, things like the trend of the stock, the momentum of that company, earnings guidance that management has provided. Are people shorting that stock or not? And all of that will translate into a sentiment grade to help guide your investment decision as well. And at the very bottom, all you're seeing there is a 1-year price return of TFC. That's that blue part of the graph, and that's relative to the benchmark in orange. If you go to the next slide, I used a name that more of us would be familiar with, Citigroup. On the previous slide, Alfred talked about this. This was down 42.5% approximately. So again, as an investor for tax loss strategies, you might say, okay, I'm going to sell Citigroup. How do I know for sure I want to get back into this company? Again, Advice Direct, you would type in the letter C, hit research, and you would pull up a report like this. And in a few seconds, you will have all of this data available to you. I'm only using 2 pages of the report. It's actually 8 pages long. I don't want to go through all 8 pages on this webinar, so I'll stick to the first 2 pages here. Again, if you look at the fundamental quadrant, we look at evaluation, it gets an A+, cash flow a B+, and an average grade for growth and profitability. And by the way, folks, one thing I forgot to mention earlier is if you look at the bottom half of that screen, right below that circle, that green, yellow, red that you're seeing, those are email triggers that we would provide you if you held that stock in terms of buy, sell, hold recommendations. And with Citigroup, again, if I look at the second half of this report, from a sentiment perspective, it gets an F for price trend and a failing grade for momentum, average grade for earnings guidance, let's say, and an A+ for short interest. And so again, you can see 1-year returns still down in that negative 40% versus the benchmark that has since recovered. So again, I use 2 stocks over here, but Alfred also talked about the ETF strategy. So if we go to the next slide, I have an ETF example. Let's bring it back home to Canada. Let's say you want to go in and you're looking at Canadian banks, or you want to go in and you're looking at Canadian ETFs, or maybe you want to go into broader US ETFs. You would simply choose a category through Advice Direct, and I've used ETFs on the screen. If you look at the tab to the right, it says mutual funds. On the tab to the left, it says equities. You could really do this for any of these. So if it was a stock or an ETF, I can put in a sector, I can put in a category. It would give me specific advice based on my individual investor profile. So when you open up an account, we understand who you are, your risk tolerance, your asset allocation, diversification, etc., and give you personalized recommendations. So here you would get a list of the best-in-class ETFs. You can sort by management expense ratios if you're cost sensitive. You can sort by dividend yields if you're looking for a higher yield on there. And you would have access to all of this great research through this Advice Direct platform. So with that, I'll end and pass it back to you, Kevin.
Well, thanks for that, Jay, and thanks for showing us some ways that tools can be used to help give people confidence, even implement a strategy like tax loss harvesting. Now, while we're on the topic of taxes, let's talk about something that a little step away from the tax loss harvesting strategy, but just to highlight at this time of the year, through the respective ETF providers out there, pay attention to the announcements that are coming out. There's generally 2 announcements that come out. One's a distribution estimate for November, and these are the estimates of capital gains that the respective ETF companies will be passing through to the end investors. So for example, if there's a rebalance through the year or something like that, there might be triggering a gain or so, and that's going to be passed through. So important to look at that and watch that. If you're holding it and you're already up, not a bigger thing, because of course you got to figure out you already have a gain inside your security, but it is a consideration before you buy something at this time of the year to take a look at that, because that'd be a distribution of a capital gain come to the year. Now, of course, you'll just adjust your cost base for that. Simple as that. But I'll also highlight, in addition to the November estimates, there'll be more of a final number in December. Now, if you're looking for this, take a look at your respective ETF companies' websites. All this is disclosed on their websites. We just posted ours out this week. And I'd say all the other ETF providers do the exact same thing. And you can even drill down and take a look at the respective information from previous years too, just to help you make informed decisions out there for your respective holdings. Anyway, it's a nice little tip. Watch for distributions this time of the year, as well as watch them in December. Just another consideration if you're buying an ETF right now, or going back to the point, if you're in a loss, factor that into as part of your decision. With that, let's switch gears. Let's go through some of the key questions that came in today. And I'm going to kick off one for John. Now, John, here's an interesting example. I know you covered off a few loopholes that people try to look at, but moving to the RSP and selling inside their cash account. What happens if somebody sells the XIC TSX cap composite and buys ZCN, the TSX cap composite, both the same index? Can I do that for tax loss selling harvest?
Unfortunately, the answer is no, Kev, but it is a great question. And it's something that comes up a lot from advisors and clients, is trying to figure out what constitutes an identical property. So CRA considers two securities to be identical properties if they're the same in all material respects, such that a prospective buyer would be indifferent between purchasing one over the other. So you really would have to look at all the interests, rights, and privileges of each security, and including the legal structure, the asset composition, the risk factors, and any restrictions of ownership, things like that, to make that determination. Now, fortunately, CRA has provided some guidance in the past regarding mutual funds, and stated that mutual funds that track the same index, even if they're from different competitors in the marketplace, would be considered an identical property. So by extension, with ETFs, in this case, since they both track the same market index, the expectation is that these would be considered identical properties. So that if you were to sell one and then repurchase the other within that 30-day period and continue to hold it, your loss would be denied as a superficial loss, and therefore that would sort of render the strategy of the tax loss selling ineffective.
But they could do something like a different ETF that's following the broad market, like a ZLB or something like that, and that would be okay, but just not specifically the same index, right?
Yeah, if you're on a different index, then there's arguably a significant enough difference between the two securities that an investor would not be indifferent between them, so that strategy would work.
Thanks for that, John. And of course, we're going to stay in that position for 31 days and come back to it if somebody wants.
Mm-hmm.
Alfred, let me bring this to you. Question coming in around growth ETF funds out there from BMO. So we certainly have a broad product line out there. Maybe you can highlight two that maybe more growth focused out there.
Sure. So I think there's two ways to tackle this question. There's one way of just getting it through one asset class. So I would say ZGQ, which is our high quality global ETF. I think that's a good way to get growth into a product or a single ETF. ZGROW, if you're looking for more of an asset allocation based ETF, is also another ETF that provides you with essentially an ETF of ETFs that is more growth focused.
Thanks for that, Alfred. I'm going to stay with you for a bit because there's a lot of questions coming in. Now, Alfred, I know you have a lot of rich experience in regards towards real return bonds. When should somebody hold them, and when don't you want to hold them, for example? And I mean, the context is here on the ETFs, of course.
Yeah, so with the real return bond, essentially how it works is that the base of the notional amounts of the bonds will adjust to inflation. So inflation being CPI in this case. So when inflation goes up, that base of that notional amount for that bond will adjust upwards. So that means you're getting more coupon payments as well. So in an inflationary environment, that is a time when you want to hold real return bonds. And obviously on the flip side, if it's a deflationary environment, that's generally not a good time to own real return bonds.
Thank you for that. Still staying with you. Thanks for the rapid fire here. Now, this person here is holding a concentrated position in regards towards banks and some corporate dividend stocks. I'd highlight there is next week, we're going to spend some time and we're going to dive directly into banks. So it's a little shout out to the show next week. We're going to talk about both Canadian and US banks and the ETFs, of course, in that space. Alfred, what's your thoughts about this kind of approach of a concentrated holding, and how do ETFs work with it?
To go really concentrated, obviously, it exposes an investor to a lot of risk. Obviously, the more concentrated your strategy becomes, you expose yourself to more, company-specific risk. And if you're concentrated in a few sectors, like this investor is asking, it does expose you to sector-specific risk as well, right? So, 2008 was a good example during the financial crisis. Even though the Canadian banks came out well ahead and proved to be, a lot more sound than their global counterparts, they still experienced quite a sell-off in 2008. So that in that case, I think you want to be diversified, not only with being in a range of broader stocks, but also having other asset classes like bonds and alternative assets in your portfolio as well. As the old adage goes, never put all your eggs in one basket. I think that definitely applies here.
Thanks for that, Alfred. And again, tune in next week to hear more about bank stocks. One more question for you here. Be interested to discuss the benefits and risks of preferred shares, another area you're quite familiar with. Give us some insights around that, please.
Yeah, so with preferred shares, I think the general risk is in the past it's there's credit risk, so there's the creditworthiness of the issuers. There's also interest rate risk as well. So the Canadian preferred share market is generally made up of rate resets, would make up 75% of the market. So they tend to be exposed to the direction of interest rates. So if interest rates go up, they benefit, and when interest rates go down, they tend to be negatively impacted as well. So that's one thing to keep in mind. One thing I will note is that certain changes in the last couple of months have made the preferred share market a little bit more stable. But overall, it's the direction of interest rates that investors have to be concerned about.
Thanks for that, Alfred. I think I'm going to go, I'll do the last question for you. Sorry there. Somebody's dipping their toe into ZedPay. And, really, they give us a little bit of background around ZedPay itself, but specifically, why is it holding U.S. Treasuries when you look underneath the hood?
Yeah, so with ZedPay, this is a strategy where we are, combining covered calls and covered puts. So we're writing call options when we're writing put options as well. The reason why we own the T-bills is because the T-bills are held essentially as collateral for the put and call options. We did, I believe, do a deeper dive on ZedPay. I think that video is available on YouTube to my knowledge.
Yep, it is. So yeah, if you're looking for more information on ZedPay, encourage you to take a look at the YouTube list. And of course, if you want to find them on YouTube, just type in BMO Market Insights. There's a whole playlist up there for you. And just take a look at some of the previous shows. We have over 30 of them now available. So take a look, lots of rich content like this show itself. And that brings us to a close for this week. We're going to be back next week on November 27th, one more time at 1 o'clock. I encourage you to send in your questions too. Look forward to answering those as well as utilize them in direction for content. And one more time, our content next week will focus in around banks. Thank you again. Have yourself a good weekend.